All right, welcome to this explainer. Today we're tackling what is honestly one of the most intriguing puzzles in the entire accounting world, dealing with the future using MFRS 137. I mean, we all know accountants absolutely love precision, right? They usually hate guessing. But what happens when the business world throws something completely unpredictable your way? How do you put a hard number on a future event that hasn't even fully played out yet? Well, that is exactly the headache this accounting standard is designed to solve. Think about this. If you get sued today, do you actually owe money tomorrow? It's a fascinating question because it gets right to the heart of the anxiety of the unknown. How exactly do you account for money you might owe? Say a customer slips in your store, or maybe a competitor claims you infringed on their patent. The lawsuit is filed today, for sure. But the actual court case, that could literally take years. So do you record that potential loss right now? Do you just kind of mention it in the footnotes? Or do you completely ignore it until the judge finally slams the gavel?
The classic 5-year warranty is a perfect illustration of this problem. When a company offers a 5-year warranty on, let's say, a microwave, they know for a fact an expense is coming. They just don't know exactly when or how much. Every single time someone buys that microwave, the company makes a promise. They know a certain percentage of those units are going to break, and they know they're going to have to pay for parts and labor. But they have absolutely no idea which specific customer will return a unit or precisely how much those aggregate repairs will cost over half a decade. It's a giant question mark.
So our ultimate goal today is answering one huge question: recognize, disclose, or do nothing. To get there, we'll walk through the future uncertainty problem, define what a provision actually is, learn the 3 rules of recognition, compare legal versus constructive obligations, tackle contingencies, and finally, look at measurement and journal entries. Let's get right into it. Section 1, the future uncertainty problem. We're going to look at navigating the unknown on your balance sheet. So how exactly do we accurately account for the unknown? Because if a company has a pending lawsuit, an upcoming restructuring, or a massive product guarantee, just ignoring it is completely misleading to investors. But guessing the cost? That's just as dangerous. Think about it from the perspective of someone actually reading a balance sheet. If you hide a massive upcoming legal settlement just because you don't know the exact dollar amount yet, you're painting a totally false picture of the company's financial health. On the flip side, if you just wildly guess and record phantom liabilities, you're equally distorting the truth. We desperately need a systematic, reliable way to capture this reality. Which brings us to Section 2. What is a provision? Let's define the core solution to our problem. Simply put, a provision is a liability of uncertain timing or amount. That's the core definition straight from the MFRS 137 standard. Now, it is still a liability, which means it's a present obligation from a past event that will definitely result in an outflow of economic benefits. The only real difference here is that the exact when and the exact how much are completely up in the air, like setting aside money for retirement benefits or those product repairs we talked about earlier. To make this crystal clear, let's contrast a standard liability with a provision. Think about trade payables. When a supplier drops off stock at your shop, they hand you an invoice. You know you owe them exactly $5,000, and you know you have to pay it in exactly 30 days. Boom. Certain timing, certain amount. That's a standard liability. But a product warranty? You sold the product. The obligation is totally real, but the timing of the claim and the exact amount of the repair costs, those remain a complete mystery. All right, moving to Section 3, the 3 rules of recognition. This is the ultimate test. Now listen closely, because all 3 of these strict rules must exist simultaneously. If even one criterion is missing, you absolutely do not recognize a provision. Okay, let's break them down. First, there must be a present obligation resulting from a past event. That means the trigger event has already happened. Second, it has to be probable that an outflow of resources will be required to settle it. Not just possible, but probable. And third, you must be able to make a reliable estimate of the amount. If you have the first 2, but you simply cannot reliably measure the cost, it fails the test. You got to check all 3 boxes. Let's drill down into that first rule in Section 4, legal versus constructive obligations. This is all about contract versus conduct. So a legal obligation is one that is forced upon you by a contract or law, whereas a constructive obligation is one you've actually created yourself through your company's past conduct and public promises. A legal obligation is super straightforward, right? It derives from legislation, an explicit contract, or operations of law. For instance, a government law dictating you have to remove an offshore oil rig. But a constructive obligation is fascinating. It happens when an entity's actions, like an established pattern of past practice or a very specific published policy, create a valid expectation in the public that the company will step up and discharge certain responsibilities.
You're essentially binding yourself through your own behavior. You can see this juxtaposition perfectly when you compare something like an Xbox console's formal legal warranty against a store like Eon's published 30-day refund policy. With the Xbox 360, Microsoft includes a physical letter of warranty guaranteeing free repairs for 12 months. That is a hard, legal contract. But then look at a retail giant like Eon or Tesco. They publish a policy stating that if you simply change your mind within 30 days, you can return the product for a full refund. Now, they aren't legally required by the government to accept returns just because you changed your mind. But their published policy creates a constructive expectation for the customer. They've made a promise, and they absolutely have to account for that.
Okay, let's apply this to a quick case study. Imagine BFFBH sold 5,000 mini drones this year. Does this pass our 3-rule test? Let's check. First, the past event is the sale of the drone with the warranty attached. That creates a present obligation. Check. Second, because it's a piece of electronics, it's highly probable that some customers will return them for repairs, leading to an outflow of resources. Check. Third, the company has past data showing an average cost to repair, which allows for a reliable estimate. Check. All 3 criteria are met, meaning this is officially a provision. But what happens when an obligation actually fails that strict test? That brings us to Section 5, contingencies. Do we disclose or ignore? Imagine a much worse scenario. A student's eye is injured by one of those BFFBHD drones, and the parents decide to sue. Management must prepare for a possible contingency loss, but this actually becomes a contingent liability rather than a provision. Why? Well, because while the past event, the injury, has definitely happened, the outcome of a lawsuit is deeply uncertain. It might not be probable that the company will lose, or it might be completely impossible to make a reliable estimate of what the judge will award. And because it fails our strict provision test, it gets downgraded to a contingent liability. This brilliant probability guide matrix is basically your ultimate cheat sheet. It gives you the exact answer to our main question. If an outflow of cash is probable and you can measure it, you recognize it on the balance sheet as a provision. But if the outflow is merely possible, like in the early days of a really unpredictable lawsuit, you don't put numbers on the balance sheet. Instead, you must disclose it in the notes to the accounts, so investors are at least aware. And what if the chance of losing money is remote? You do absolutely nothing. Total silence. No disclosure needed. Here's a rapid-fire checklist for you. You can recognize things like product warranties, dismantling and restoration costs like those offshore oil rigs, and onerous contracts. But you cannot ever recognize future operating losses, staff training, or major overhauls. This is a super common trap. A company might anticipate a terrible financial year ahead and try to create a provision for future operating losses just to soften the blow. But the standard strictly forbids this. Future operating losses do not stem from a past event. You can always change your business model or even close the business entirely before those losses happen, which means you have a realistic alternative. Therefore, there's no present obligation, and no provision can be recognized. Finally, we're at Section 6, Measurement and Journal Entries. This is the final step where we actually get this onto the balance sheet. The rule here is you must use the best estimate of the expenditure. The standard demands that you consider all risks and uncertainties to find this number. Let's look at the math from our drone warranty example. Imagine you have a new batch of goods. You estimate that 15% will have minor defects, costing RM 1,000 to fix in total. That gives you an expected value of RM 15,000. Then, you estimate 5% will have major defects, costing RM 500,000 to fix, which adds another RM 25,000 to your expected value. You just add those probabilities together. RM 15,000 plus RM 25,000 equals your best estimate of RM 40,000. And there it is. That's the magic number you're going to use. To properly satisfy the standard and balance your books, your fundamental journal entry will always be to debit the expense and credit the provision. In the case of our RM 40,000 warranty calculation, you would debit warranty expense for RM 40,000. This hits your profit and loss statement immediately, recognizing the real cost of doing business. At the exact same time, you credit provision for warranty for RM 40,000. This establishes that carefully calculated liability right on your balance sheet, perfectly preparing you for those future claims. So, as we wrap up this explainer, I want to leave you with this thought. The next time a major business uncertainty hits your desk, which path of the decision tree are you going to choose? Will you be able to identify if it's a true provision born of a past event, a mere contingency just waiting in the wings, or a remote distraction that you can just ignore? Mastering MFRS 137 isn't just about balancing the books. It's really about seeing the future of a business with total clarity. Until next time, keep questioning the numbers.